So as we highlighted previously that the basis of the transfer pricing is the arm's length principle, which means that the price agreed between two related parties should be similar to the price agreed between two unrelated parties in a comparable circumstances. Also, as we explained that, to be able to test on whether a related party transaction is arm's length or not, then you need to compare between the conditions around a controlled transaction with the conditions that would be applied between independent parties, enabling us to finally reach a reliable measure of an arm's length result, which is the job of the comparability analysis or the benchmarking analysis. And today, let's briefly understand the benchmarking steps and process in this video. Hello everyone and welcome to the TaxGate. Hit the subscribe button and let's get started. Well, the benchmarking analysis is the process of identifying the arm's length range of a price or margin, enabling us to compare that price or margin in a controlled transaction with this identified range. And here benchmarking analysis help to produce a range of values, and that's what we call the acceptable arm's length range, and this is to use it as reference to compare between the following: the price or margin in a controlled or related party transaction and the identified acceptable range. And this is to finally check on whether the mentioned controlled transaction is arm's length or not. Well, so what if the transfer price determined by a taxpayer for the transaction under the test is not found within the acceptable arm's length range? Accordingly, the competent tax authority will determine the arm's length price of the transaction under review, and then transfer pricing adjustment would be in place. Good. That was a quick introduction benchmarking analysis, and now let's understand how we can perform a transfer pricing benchmarking process. Well, just to simplify, benchmarking analysis would mainly focus on testing the following: the controlled transaction under review and the uncontrolled transaction that would be used potentially as a comparable. Well, so usually the following steps would be done upon performing a transfer pricing benchmarking study. So, the first step would be to determine the years to be covered under the benchmarking study. And here we would highlight that normally the benchmarking study covers 1 year where the controlled transaction was performed. However, some businesses wouldn't go through a significant changes during the following periods, and accordingly it would be flexible to update the benchmarking study every 2 to 3 years. Also, let's keep in mind that the jurisdiction itself and the economic circumstances would be the key indicator to determine such. Good. The next step here would be conducting the broad-based analysis. And here the broad-based analysis is a very important step in the comparability analysis or the benchmarking process. This step helps to understand the economic circumstances around the transaction and also to analyze the taxpayer circumstances, including the industry, the competition, the economic and regulatory factors, and also any other elements that would materially affect the company. So, it is an analysis for the conditions around the controlled transaction to be compared with the same around the uncontrolled transactions. Good. So that was for the broad-based analysis, and now let's move to the next step here, which is reviewing the controlled transaction under the test and choosing the tested party. Well, in order for you to be able to select and apply the most appropriate transfer pricing method, then you would need the sufficient information around the transaction, mainly on the 5 comparability factors, and particularly on the functions, assets, and risks assumed, including the foreign associated parties as well. And that is the job of this step, which is to review the controlled transaction in order to identify the factors that would impact the choice of the following: the selection of the tested party, the most appropriate transfer pricing method, the financial indicator that will be tested if a transactional profit methods were chosen, and finally the selection of comparables and the determination of comparability adjustments if it is required. Good. Now for the choice of tested party. And here we should highlight that the selection of the tested party is very important, as it also determines the selection of the potential comparables. So, as a general rule, the tested party is the one where the transfer pricing method can be applied in the most reliable manner, and also the most reliable comparables can be found. And also it should be highlighted that the choice of the tested party should be consistent with the functional analysis of the transaction and the characterization of the entity as well. Good. And now with the next step here, which is to review the existing internal comparables. Well, let's first highlight that the comparable uncontrolled transaction is simply a transaction between two independent parties that is comparable to our controlled transaction under review. And here the comparable uncontrolled transaction can be as follows. Either an internal comparable, which would a comparable transaction between the controlled transaction and an independent party. Or external comparable, which would be totally between two independent enterprises. Also, it would be clear that the internal comparables would have a direct and closer relationship to the transaction under review more than the external comparables. Well, now moving to the next step here, which is the determination of the available sources of information on external comparables. So, when we have a reliable internal comparables, then it is unnecessary to search for external ones. However, if it is necessary to search for external comparables, then we would have various sources of information that can be used. The common source of information here is the commercial databases, and all databases would be mainly categorized into different types, depending on the searching information, as follows. We would have a database for the comparable companies for the sales of goods and intergroup services. Also, we would have a database for the interest rates for financial transactions. And also database for remuneration rates for intangible transactions. And finally, we would highlight that globally there are several database providers for each transaction type. Good. Now let's move further with the next step today. The selection of the most appropriate transfer pricing method and financial indicator. And here all we need to highlight that the most appropriate transfer pricing method should be selected based on the following. The type of the controlled transaction, the results of functional analysis, and the availability of information for the internal and external comparables. For the transactional profit methods, it is necessary to select relevant financial indicator to be tested accordingly. This video provides a quick overview on the transfer pricing methods that would entitle you to have a better understanding for this step. Well, moving further. The next step in the process is to identify the potential comparables. The process of identifying the potential comparables is really critical, and it should be transparently and systematically done. Being specific, the selection criteria applied on the transfer pricing benchmarking database has a significant influence on the outcome of the analysis, as it should reflect the most meaningful economic characteristics around the transactions compared. Here, to ensure the transparency of the process, is to be able to explain the criteria of using the potential select comparables, same as being able to disclose the reasons for excluding some of the potential comparables. Well, so, best to the practice and according to OECD guidelines, identifying the potential comparables would be done through two main approaches as follows. The additive approach and the deductive approach. For the additive approach, it involves drawing up a list of third parties, for example, the client's competitors who would carry out potential comparable transactions, and then collecting information on those transactions to see whether they provide acceptable comparables based on the predetermined comparability criteria. This approach may be used as the sole approach if the taxpayer has the knowledge of a few appropriate third parties as potential comparables. And just to highlight that the main challenge here with this approach is that you may not have enough data on the potential comparable companies. Well, that was the additive approach, and now let's move to second approach here, which is the deductive approach. The deductive approach is commonly used. This approach starts with a wide set of companies as obtained from the database search, which operate in the same sector of activity, perform similar broad functions, and do not have a material difference in the economic characteristics. And then this set is refined or enhanced using the selection criteria and the public available information as indicated by the guidance of identifying and assessing the potential comparables. And here once again, the choice of selection criteria has a major influence on the outcome of the comparability analysis and should reflect the most significant economic characteristics of the transactions compared. Also, let's keep in mind that we need to identify comparables to our controlled transaction, not to the company itself. Well, moving to another step here, which is the determination of making comparability adjustments if needed. So, to be comparable means that any identified differences between the circumstances around the transactions under the test would materially impact the comparison or lead to reasonably accurate adjustments that can be made to eliminate the effect of such differences. The adjustments are normally made when it is expected to improve comparability. Also, to ensure the needed level of transparency of comparability adjustments, then this would depend on the following: the reasons for the performed adjustments, how they were calculated, how they changed the results for each comparable, and how the adjustment improves comparability. Good. And now with the final step today, which is the interpretation and use of the collected data in order to determine the arm's length remuneration. Well, so based on the comparable's financials, it is possible to identify the arm's length remuneration. And here the price or margin of the controlled transaction either to be within the arm's length range and accordingly no adjustment should be made. Or, the price or margin of the controlled transaction falls outside the arm's length range, which will automatically trigger transfer pricing adjustment. And here we should highlight that the taxpayer will have the full right to present the arguments that the conditions around the controlled transaction satisfy the arm's length principle, and that the result falls within the arm's length range, and that's why having a solid benchmarking analysis should support the company's position during any discussions with the tax authority. Well, so how the arm's length price is determined, and the answer to this question is as follows. In some cases, the process may arrive at a single arm's length figure, either a price or a margin, mainly when using traditional transaction methods where specific comparable data exists. In other cases, a range of equally reliable figures would be in place when dealing with more complex transactions that require the use of transactional profit methods, and this would be the case when a commercial database is used where a list of companies proposed as comparables would be produced along with the sufficient information to allow a comparison between the transaction under the test. Well, so here in this case, if the range includes a large number of observations, then it may be appropriate to apply statistical techniques that narrow the range around the center by excluding some of the uncontrolled transactions that have a less degree of comparability. And here we would highlight that there are two basic statistical techniques used for calculating the arm's length range of acceptable profit margins: the interquartile range and the other percentiles. And the interquartile range is perhaps the most common statistical technique that is normally used. The interquartile range method focuses on the middle 50% of the data points in the dataset by excluding the outliers and extreme data points, which would accordingly arrive at a stable and conservative arm's length range. So, simply it provides a more reliable analysis, especially if the tax authority prefers the conservative approach. However, the full range, for example, would include all data points in the dataset without excluding outliers. So, it provides a broader analysis which allow a greater flexibility and a more inclusive approach of the analysis. And this would be beneficial for the companies that seek to support their transfer pricing position with a broader range of comparables, or where the benchmarking study lacks sufficient data points to calculate a reliable interquartile range. Well, that was a quick overview of the benchmarking process, and now just to conclude. Let's always keep in mind that even with a well-conducted benchmarking analysis, the risk that tax authority is going to challenge the benchmarking study is always in place, and that's why, once again, having a solid benchmarking analysis should support the company's position during any discussions with the tax authority. Like and subscribe for more interesting tax videos, and thanks for watching TaxGate.